Many beginning investors do not understand what a dividend is as it relates to an investment, particularly for an individual stock or mutual fund. A dividend is a payout of a portion of a company's profit to eligible stockholders, typically issued by a publicly traded company. However, not all companies pay a dividend. Usually, the board of directors determines if a dividend is desirable for their particular company based on various financial and economic factors. Dividends are commonly paid in the form of cash distributions to the shareholders on a monthly, quarterly, or yearly basis. In this video, we are going to talk about investing in high dividend stocks for beginners. If you are interested, so stay tuned into the video. Definitely you will find some value. Let's move on towards the topic. Dividend Basics. Shareholders of any given stock must meet certain requirements before receiving a dividend payout or distribution. You must be a shareholder of record on or subsequent to a particular date designated by the company's board of directors in order to qualify for the dividend payout. Stocks are sometimes referred to as trading ex-dividend, which simply means that they are trading on that particular day without dividend eligibility. If you buy and sell stock on its ex-dividend date, you will not receive the most current dividend payout. Now that you have a basic definition of what a dividend is and how it is distributed, let's focus in more detail on what more you need to understand before making an investment decision. What is the dividend yield? It may be counterintuitive, but as a stock's price increases, its dividend yield actually decreases. Dividend yield is a ratio of how much cash flow you are getting for each dollar invested in a stock. Many novice investors may incorrectly assume that a higher stock price correlates to a higher dividend yield. Let's delve into how dividend yield is calculated so we can grasp this inverse relationship. Dividends are normally paid on a per-share basis. If you own 100 shares of the ABC Corporation, the 100 shares is your basis for dividend distribution. Assume for the moment that ABC Corporation was purchased at $100 per share, which implies a total investment of $10,000. Profits at the ABC Corporation were unusually high, so the board of directors agrees to pay its shareholders $10 per share annually in the form of a cash dividend. So as an owner of ABC Corporation for a year, your continued investment in ABC Corp result in $1,000 of dividends. The annual yield is the total dividend amount, $1,000, divided by the cost of the stock, $10,000, which equals 10%. If ABC Corporation was purchased at $200 per share instead, the yield would drop to 5%, since 100 shares now costs $20,000, or your original $10,000 only gets you 50 shares instead of 100. As illustrated above, if the price of the stock moves higher, then dividend yield drops and vice versa. Dividends are a piece of a company's profits paid out to eligible stockholders on a monthly, quarterly, or yearly basis. Generally, a company's ability to pay dividends is a sign of good corporate health. Are you still watching my video? So defiantly you will like my other videos as well. If you are interested in stock market or investing, and you don't subscribe to my channel yet, so subscribe right now because I upload these types of videos regularly. Now move on towards the topic. Assessing dividend-paying stocks. The real question one has to ask is whether dividend-paying stocks make a good overall investment. Dividends are derived from a company's profits, so it is fair to assume that in most cases, dividends are generally a sign of financial health. From an investment strategy perspective, buying established companies with a history of good dividends adds stability to a portfolio. Your $10,000 investment in ABC Corporation, if held for 1 year, will be worth $11,000, assuming the stock price after 1 year is unchanged. Moreover, if ABC Corporation is trading at $90 share a year after you purchased for $100 a share, your total investment after receiving dividends is still break-even $9,000 stock value, plus $1,000 in dividends. This is the appeal of buying stocks with dividends. It helps cushion declines in the actual stock prices, but also presents an opportunity for stock price appreciation, coupled with a steady stream of income from dividends. This is why many investing legends such as John Bogle and Benjamin Graham advocate buying stocks that pay dividends as a critical part of the total investment return of an asset. The risks to dividends. During the financial meltdown in 2008 or 2009, almost all of the major banks either slashed or eliminated their dividend payouts. These companies were known for consistent, stable dividend payouts each quarter for literally hundreds of years. Despite their storied histories, many dividends were cut. In other words, dividends are not guaranteed, and are subject to macroeconomic as well as company-specific risks. Another potential downside to investing in dividend-paying stocks is that companies that pay dividends are not usually high-growth leaders. There are some exceptions, but high-growth companies usually do not pay sizable amounts of dividends to its shareholders, even if they have significantly outperformed the vast majority of stocks over time. Growth companies tend to spend more dollars on research and development, capital expansion, retaining talented employees, and or mergers and acquisitions. For these companies, all earnings are considered retained earnings and are reinvested back into the company instead of issuing a dividend to shareholders. It is equally important to be aware of companies with extraordinarily high yields. As we have learned, if a company's stock price continues to decline, its yield goes up. Many rookie investors get teased into purchasing a stock just on the basis of a potentially juicy dividend. There is no specific rule of thumb in relation to how much is too much in terms of a dividend payout. Special considerations. The average dividend yield on S&P 500 index companies that pay a dividend historically fluctuates somewhere between 2% and 5%, depending on market conditions. In general, it pays to do your homework on stocks yielding more than 8% to find out what is truly going on with the company. Doing this due diligence will help you decipher those companies that are truly in financial shambles from those that are temporarily out of favor and therefore present a good investment value proposition. I hope now you understand how you can invest in high dividend stocks, so that's it for today. And if you will find my video valuable, so don't forget to like and subscribe. We'll meet again with another interesting topic. Till then, stay safe and stay happy.